Vanguard has 0 ETFs on the platform right now, and most investors still do the same thing. They open the list, CVO, CVTI, maybe recognize one of the dividend funds, and then stop looking. There is nothing wrong with that, but it also means they are ignoring more than 5 other options sitting in the exact same place. And that is what makes this question interesting. Because once you move past the ETFs everyone already knows, Vanguard's lineup gets much wider and much less obvious. Large cap, mid cap, small cap, international, sector funds, dividend funds, factor funds, bond funds. The menu is much bigger than most people ever bother to explore. So in this video, the goal is simple. Take Vanguard's ETF lineup and test it properly. What would have happened if you had put each Mondor into every Vanguard ETF and just let the numbers speak for themselves? Not based on opinions, not based on which fund gets mentioned the most, just performance. To make the comparison fair, I use 2 time frames. The first is the 1-year return, which shows what happened over the last 20 months. That number matters because it tells you what is working right now, but it can also be misleading. One strong year can come from a rebound, a short-term trend, or one unusual macro setup. So the second number matters more. The 5-year average annual return is what decides the winners in this video because 5 years is long enough to include rate hikes, drawdowns, recoveries, inflation shocks, and everything in between. 1 year can be noise. 5 years starts to look like a pattern. Now, technically, Vanguard has year-good ETFs, but not all of them had enough history to be taken seriously in this kind of test. Some launched recently, some are only a few years old. And if a fund did not have at least 5 years of real performance data, it was out. That filter brought the field down from being too julok. That still left a lot to work with. Before getting into the stock ETFs, though, we have to deal with the other side of Vanguard's platform, the bond funds. Out of those julok ETFs, Juzix were bond ETFs. Treasury bonds, corporate bonds, inflation-protected securities, international bonds, tax-exempt bonds. Vanguard covers the whole fixed income spectrum. Now, I know nobody clicks on a video like this hoping the answer is going to be a bond ETF, and the good news is that it is not. But they are part of the lineup, so they had to be tested. The best 5-year performer in the bond category was VTIP, Vanguard's short-term inflation-protected securities ETF. Mondor investment there grew to about Yen, Kubai Wandru Sandor. Respectable but not exactly explosive. At the other end was BND, probably the most well-known bond fund on the entire platform, and a chanters there turned into just over a chanters after 5 years. That is the kind of result that looks safe until you remember inflation was running much hotter than that. In other words, the money may have stayed there, but its purchasing power did not. There is a reason for that. The last 5 years included one of the sharpest rate hiking cycles in decades. When rates rise, existing bond prices fall. Short duration bonds recover faster because they mature quickly and roll into higher rates. Longer duration bonds get stuck earning older, lower yields for longer. And broad funds like BND, which hold a mix of everything, got dragged down by that environment. The 1-year picture looked a little better. Some bond funds bounced. Some caught a recovery in yield demand, but the bigger point stayed the same. The entire bond segment ended up packed into a very narrow range. They preserved capital, they did their job as ballast, they just did not win anything. And that matters because this video is not about finding the ETF that loses the least. It is about finding the ETF that actually turned a Chamdoro into something meaningful. Once the bond funds are out of the way, the real competition starts. That leaves Lucian stock ETFs across 7 segments. And the first one up is the area most people skip right past without thinking twice. Mid-caps. These are the companies stuck in the middle. Too big to be small caps, too small to be the giant names everyone talks about. Most investors treat them like background noise. That turns out to be a mistake. Because once I ranked Vanguard's mid-cap ETFs by 5-year return, the results were not what most people would expect. The winners were not the growth funds, they were the value funds. And the reason says a lot about what the last 5 years actually rewarded. That is where we go next. In the mid-cap segment, Vanguard had 7 ETFs with enough history to qualify, and this is where the first real surprise showed up. Most people assume mid-caps are just an awkward middle ground. Too small to get the spotlight, too big to feel exciting, but the last 5 years tell a very different story. The top performer in the group was VOE, the Vanguard Mid-Cap Value ETF. Ichimandoro investment there turned into about Ichimanega Sanbaidoro over 5 years, which worked out to roughly an pasenda Ju10 ni average annual return. That was not just a decent result, it was a strong one, especially for a segment most investors barely think about. Second place went to IVOV, and third went to IVO, and what stood out immediately was that the top three were all value funds, not growth, not momentum, value. That matters because it tells you something about what the market rewarded over this stretch. The last 5 years were shaped by one of the most aggressive rate hike cycles in decades. When rates rise, the companies that get hurt the most are often the ones priced on future expectations, the growth names whose valuations depend heavily on earnings that are still far down the road. Value companies are different. They already have cash flow. They already have profits. They are less dependent on a low-rate environment to justify their price. That gave them an advantage. At the bottom of the 5-year ranking sat VXF, the Extended Market ETF. On paper, the name sounds like you are getting more exposure and more opportunity. And technically you are, but you are also getting more of the weaker parts of the market that struggled during this cycle. That is the trade-off. More coverage does not automatically mean better returns. Then the 1-year rankings changed the story. Suddenly, VOTE jumped much higher, and the gap between the top and bottom tightened dramatically. Over 1 year, the difference between the winning mid-cap fund and the runner-up was tiny compared with the 5-year table. What that tells you is simple. Once the market started anticipating future rate cuts, growth began finding its footing again. The same style that struggled over the full 5-year period started recovering much faster in the shorter 1-year window. Same funds, same platform, completely different ranking depending on where you zoom in. And that pattern became even more dramatic when the focus moved from mid-caps to small caps. This was one of the most volatile segments in the entire test. Vanguard had 9 ETFs in the small cap category, and the spread between the best and worst performers was wider than what we saw in mid-caps by a mile. If mid-caps gave us a clue, small caps made the message impossible to miss. The top 5-year performer was VBR, Vanguard, a small cap value ETF. Ichimandoro investment turned into about Juliodor Yuyong. Second place went to VTWV, and third went to VB. Once again, value funds sat at the top. And the reason looked familiar, but even stronger here. Small companies tend to carry more debt than large ones, and a lot of that debt is more sensitive to interest rates. So when the Fed raised rates, smaller growth companies got squeezed hard. Borrowing costs rose quickly, and companies that did not already have strong earnings had a much harder time absorbing that pressure. Small cap value funds held up better because the underlying businesses were in a stronger position to weather it. Then you look at the bottom of the 5-year ranking and the contrast becomes extreme. VTWG, Vanguard Small Cap Growth ETF, lagged badly. The spread between the top and bottom in the segment was nearly Gosendor from the same Ichimandoro starting point, same part of the market, same 5 years. Completely different result depending on whether you owned value or growth. But again, the 1-year picture told a different story. Growth started coming back. Some of the worst 5-year performers suddenly came back to life once the market began pricing in the possibility of lower rates ahead. So the small cap segment ended up showing 2 truths at once. Over 5 years, value dominated. Over 1 year, growth staged one of the strongest recoveries anywhere in the test. That set up the obvious next question. If that pattern showed up in mid-caps and small caps, what happened in large caps, the segment everyone actually cares about, the one where VO and VTI live, and the part of the Vanguard lineup most investors never move beyond? That is where the rankings got even more interesting, because the ETFs most people assume are the winners did not actually finish at the top. When we move into large caps, this is where most investors expect things to get predictable, because this is the part of the market everyone already knows. This is where funds like Vanguard SP Gobak ETF, VU, and Vanguard Total Stock Market ETF, VTI live. And for many people, this is where the search usually ends. But once you actually rank all Jurok Vanguard large cap ETFs side by side, the results don't line up with that expectation. The 5-year winner was Vanguard Mega Cap ETF, MGC, not VOO, not VTI. Each Mandur investment there grew to roughly each man Jushen Nambia Liu Judor, outperforming both of the popular funds. And the reason becomes obvious once you look at what MGC actually holds. It is far more concentrated in the largest companies in the market, names like Apple, Microsoft, Nvidia, Amazon, companies with massive cash reserves, dominant positions, and very little dependence on borrowing. That concentration mattered. While broader funds like VTI hold hundreds or even thousands of stocks, including weaker performers, MGC focused heavily on the biggest winners, and that focus pushed it to the top. When you look at the rankings, VU came in around 5th place, still strong, but not the winner. VTI ranked even lower. Then once again, the one-year table flipped the entire picture. The top performer over the last 2 months was Vanguard Total World Stock ETF, VT, not a US-only fund at all. VT includes global exposure, and over that one-year window, it delivered about a % return, jumping from near the bottom of the 5-year ranking to the very top of the one-year list. That contrast is exactly the kind of thing most investors miss. Over 5 years, US large caps dominated. Over 1 year, global exposure took over. That brings us to one of the most overlooked segments on the entire platform, factor ETFs. Most people have never even heard of them, and that is exactly why they are interesting. Instead of tracking a broad index like the SPJ, factor ETFs select stocks based on specific traits, things like value, momentum, or quality. Think of them as filters applied on top of the market rather than just mirrors of it. Vanguard has 5 of these, and the 5-year winner was Vanguard US Multi-Factor ETF, VFMF. Ichimandu investment there grew to about Ichimanju Sanyong Bialoju Julodu, slightly beating VU itself. That is important because it shows that even within the same market, a different selection method can produce different outcomes. At the other end was Vanguard US Quality Factor ETF, VFQY, which lagged behind. Focusing only on quality was not enough in this cycle. The multi-factor approach, balancing value, momentum, and other signals proved more effective over time. And again, the one-year ranking told a different story. Momentum-focused funds like Vanguard US Momentum Factor ETF VFMO surged to the top, but their 5-year performance was weaker. Momentum works extremely well during strong trends, but it also reverses quickly when those trends break. The multi-factor approach stayed more balanced, which is why it won the longer race. From there, the analysis moved into one of the most popular segments, dividend ETFs. Vanguard only has 4 of them, which makes it a small group, but this is where one of the most surprising results in the entire test showed up. The clear winner was Vanguard International High Dividend Yield ETF, VYMI. And what made it stand out was not just that it performed well, but that it performed well across both time frames, over 5 years. Ijimando grew to about a Ijingjang to dozer, delivering roughly a Jushin Bachendri to annual return. Over 1 year, it jumped to about 100句用 a 趴线的样去, 这个 return in just 9 months. That kind of consistency across both short-term and long-term rankings almost never happens in a data set like this. And most investors have never even looked at it. VYMI holds over 10 VP stocks across more than Yongro countries with heavy exposure to sectors like financials and energy. It benefits from higher dividend yields, global diversification, and valuation gaps between international and U.S. markets. Over the last year, 2 factors helped it surge. International stocks were trading at a discount relative to U.S. stocks, and the U.S. dollar weakened, which increased the value of foreign holdings when converted back into dollars. At the bottom of the dividend category sat Vanguard International Dividend Appreciation ETF, VG, which focuses on dividend growth instead of high yield. That sounds good in theory, but over the last 5 years, companies paying higher dividends right now outperform those slowly increasing them over time. Immediate income beat future growth in this specific cycle. Then came the international segment as a whole, and this is where the biggest one-year performance in the entire test appeared. Vanguard FTSE Pacific ETF VPL turned each mandur into about each mangusan 9%in just 1 year. A Pasiendu Wajra return, the highest of any ETF in the entire data set. But over 5 years, VPL was only average. That is the key lesson. For most of that 5-year period, it did nothing special. Then one explosive year rewrote its entire performance history. That move was driven largely by Japan, which makes up a big portion of the fund. Japanese companies began restructuring, buying back shares, improving capital efficiency, and boosting shareholder returns. Combined with currency effects, that created a powerful surge. And that leads directly to the final and most important segment, sector ETFs. This is where the overall 5-year winner of the entire competition was hiding the whole time. The top performer was Vanguard Energy ETF, VDE, which turned Adamandur into about Nimao Faqian Zabia Chu, nearly tripling the initial investment. Nothing else came close. The gap between first and second place was over, non-ascendor, which is massive considering the same starting point. And the reason again comes back to macro conditions. Energy stocks were crushed during the pandemic, then demand surged back, supply stayed tight, oil prices climbed above $1, and companies like Exxon and Chevron generated record profits. That entire cycle flowed directly into VDE's performance. But just like before, the one-year table told a different story. Vanguard Industrials ETF, VIS, took the top spot, driven by infrastructure spending and reshoring trends. Wine, Vanguard Financials ETF, VFH, dropped to the bottom despite strong long-term performance, and that brings everything together. After ranking all non-Ajudok ETFs across 7 segments, there were really 2 winners, each representing a different idea. If you judge purely by returns, VDE is the clear winner. But its performance was driven by a very specific rare setup that may not repeat. If you look for something more balanced, something that performed well across both timeframes and still has a structural case behind it, then VYMI stands out. And that leads to the most important takeaway from this entire analysis. The ETF that wins today is not guaranteed to win tomorrow. Leadership rotates, and it rotates hard. After going through all non-Ajudok ETFs across 7 segments, the results come down to something much simpler than most people expect, and at the same time much harder to act on. Because the data doesn't point to one perfect ETF, it points to a pattern. And that pattern is rotation. Over 5 years, the US dominated. Large caps, especially concentrated exposure to the biggest companies, came out ahead. Sector bets like energy delivered extreme returns when the setup was right. Value outperformed growth across multiple segments because of rising rates. That was the environment. Then you zoom into 1 year, and the entire map flips. International funds take the lead, growth starts coming back, momentum surges, regions that lagged for years suddenly outperform everything else in a matter of months. The same ETFs that looked average or even weak over 5 years suddenly jump to the top of the leaderboard. Same platform, same funds, completely different winners. That is the part most investors underestimate. Because most people are not choosing between non-Ajudok ETFs. They are choosing between 2 or 3. And usually they are choosing based on what worked recently or what they hear the most about. But the data here shows something very different. The best performing ETF depends heavily on when you measure it. The 5-year winner was Vanguard Energy ETF, VDE, driven by a once-in-a-decade cycle in energy markets. The most consistent performer across both timeframes was Vanguard International High Dividend Yield ETF, VIME, benefiting from global diversification, higher yield, and valuation gaps. The biggest one-year return came from Vanguard FTSE Pacific ETF, VPL, powered by a surge in Japanese equities. 3 different ETFs, 3 different stories, 3 different reasons for winning. And that leads to a much better question than which ETF is the best. The better question is, what role does each ETF play in a portfolio? Because chasing the last winner is not a strategy, it is a reaction. If you bought VDE after it already tripled, you are not buying the same setup that created that return. If you ignored international funds for 5 years and only looked at them after one strong year, you are reacting to performance, not positioning for it. That is where most investors lose the advantage. The real takeaway from this entire breakdown is not that one ETF is better than the rest. It is that different parts of the market lead at different times, and if your portfolio only reflects what worked recently, it will always be one step behind. So instead of asking which ETF won the last 5 years, the more important question becomes, how do you actually build something that can handle all of these rotations without constantly trying to guess them? And that is exactly what the next step is about. If you want to see how to take a small amount, like Wasendor, and turn it into a structured ETF portfolio that balances growth, income, and global exposure without guessing the next winner, then click the video on the screen right now.